Hi, Dominique. Kicking off another week ahead, I guess we kind of call it. Key events for the upcoming week. As Bilal did on his podcast that I heard today, let's timestamp it, considering how fast things are moving and obviously how important geopolitical events are around affecting kind of monetary policy. So it is the afternoon on Sunday, March 6th from London and obviously, I guess, late morning in the West Coast in the US. Maybe let's quickly go over kind of what things stood out from last week, certainly from, say, the Fed and the data that came out.
Sure. So the data that came out was actually good for the Fed, but sadly, no longer relevant. What was good for the Fed is that the NFP saw a recovery in supply, in participation, actually 60 basis point increase in prime age male participation. So that was really good because it means less inflationary pressure, all the things the Fed was looking for.
Right.
Unfortunately, that's no longer relevant. The biggest risk.
But that was a surprise to most people, to most economists, I guess.
But not to me. I had expected it. We discussed it last week.
Yep.
Basically, people got so much money from the federal government, especially people on very low income, that they could afford to take a holiday from the labor market. Now the money has been spent. They need to pay the bills, so they have to come back to work, especially since the pandemic is more or less over for now.
Right.
Until the next spike, which is going to be probably next winter.
Right. So and wages also were a bit more temperate than people thought.
Sorry, what was temperate?
Wages.
Wages. Yeah. Oh, yes. This one is really important too. Thank you for making the point. Wages were flat, which was my expectations that we would see a slowdown. We had seen the slowdown in Q4 in the economy, in the employment cost index, which is a more reliable wage measure that the Fed is looking at. And also, if supply increases, economists are very simple-minded people. Higher supply, lower prices. So the US went down. So this was really good for the Fed, but no longer relevant.
But obviously, there's a lot of other things going on in the world. Quick question, not to just totally put you on the spot, and obviously there's so many other factors, mainly the Russian invasion into Ukraine. But what would you put as the possible recession in the US? And is a recession in Europe, maybe a simple question, much higher probability?
So my sort of big picture view, and I hope people read the note I wrote on this about a week ago. We are headed towards an oil shock. And given where we are with inflation well above target everywhere, central banks will have no choice but to tighten, when usually they would just let the commodities price shock play out. But given where inflation is, where inflation expectations are, where unemployment is, especially in the US, central bank will be forced to tighten. They will all do that at the same time, and will probably get a global recession. So what's the timing for that? End of this year, beginning of next year. I think this coming quarter is when we see the oil price shock play out. And then Q3, Q4 is when the growth really starts to slow.
Right. Okay, great. So what else happened last week?
We finally got Chair Powell to talk to us. And he made a very big, emphatic historical statement on his willingness to be the next Paul Volcker if that was needed. Gosh, that was a really striking statement. But what he said a couple of sentences later was a bit inconsistent. So first of all, contrary to my expectation, he said that he would he would favor 25 basis points in March. So that one I think is settled. But the most
even if we have a high CPI this week.
The Fed. So the problem is the Fed doesn't really have a framework to understand inflation. And to be fair, no one else really has. But with this chair, who is very reactive to short-term data development, even less of a framework than usual. So if we had Yellen or Bernanke as chair, I would say no, one data point is not going to change the decision of the Fed. So I'll say even with a higher than expected CPI, probably he will stick to the 25 basis point because he's a little worried about, what will happen with the war, which, I mean, to be fair, he should be worried. That's his job as the head of the Fed. Yeah.
Okay.
So, yes, so he said, I will be the next Paul Volcker if history calls upon me to do that. But at the same time, he says, I will wait until H2 to see if inflation is not coming down, if I expect. And if it's not coming down, I'm prepared to do 50 basis points at a meeting or meetings with an S. So I hope is not going to be so reactive, because if so, it would mean that the Fed would fall even further behind the curve, would have to slam the brakes harder, and that would make for more of a downturn in the US economy. And just to be clear, I am still in the camp that the inflation regime we are in is a low inflation regime, but we are getting two supply shocks on top of another. The first one was the COVID, and then we're getting the war and likely an oil shock. And so hopefully he is going to realize that if we are in the oil shock scenario, which we should know within the next couple of months, say by the next Fed meeting, then he's not going to get the slowdown in inflation that he expects. And to avoid inflation going even higher, he will have to tap the brake stronger.
Yeah. Okay. Yeah, so I guess you kind of answer the question. So really, you're going to be looking at CPI. Anything else from a data standpoint? And obviously, as you said, the focus is really going to be on the war and what actions that the West continue to do, and obviously what Putin is.
Totally. I mean, what investors need to look is the prospect of a complete shutdown of Russian energy export. And so they need to look at the duration of the conflict, the risk of atrocities, which is quite high, because this is
getting worse.
Getting worse, because this is going to put pressure on Western governments to cut down energy exports. And in fact, there are some news this morning that the Secretary of State, Blinken, is actually discussing with the Europeans to do just that. And remember, we are almost in spring. So if the Europeans decide to ban Russian energy exports, they have about 6 months to get ready for the winter. So the timing is also quite good.
So it could happen, right? They have enough to get through the rest of the winter.
So I would say that relative to when I wrote my note on the risk of oil shock, the risk have gone up because the war has gone worse. And so the public opinion pressure to really put pressure on Russia has gone up. So that's the news that investors need to get focused on. And in terms of market impact, what's going to happen is that even if Chair Powell does not wait until H2, because what does waiting until H2 means? It means he's waiting until the July CPI comes out, which is in August, and then the next FOMC meeting is in September. So, which is like totally unrealistic. He will have to react before then, but he will react with a lag. And in all fairness, that's what he needs to do as a central banker. He
Right.
doesn't have the luxury of telling the whole world an oil shock is coming, because obviously what he writes or says has a lot more market impact than what I write or say. So he has to be very measured, careful, prudent in his assessment.
Yeah.
But that means, there is a good chance of a curve steepening, simply because, as I've just explained, given the ways Fed implement policies, they have to take their time. And so the reaction from the Fed will come a bit later relative to the market reaction to the oil shock.
Do you think, one of the investors asked, which I hadn't got a chance to, had asked me, and I wanted to speak to you and Bilal, I guess ask you, is how much, let's say inflation doesn't really come down for a variety of reasons we discussed, but the curve inverts, say 2s10s inverts. Will that slow them down?
Well, if you believe Mr. Powell's very historical statement that he was ready to be the next Paul Volcker, the answer is no. Basically, if inflation shows up, they are going to have to bring the economy to a recession to bring down inflation, because they've been saying inflation reflects a supply shock. Supply shock should go away, inflation should slow down. But if inflation doesn't slow down in the second half, it means the supply shock is still there, and they need to bring the demand that we have in the economy in line with the lower supply. And in plain English, it means a recession.
Yeah. Okay. Okay, great. Anything else that people should be thinking about or concerned about, or track, or like you're specifically tracking? And
everything else is a bit of a sideshow. So we have the usual conflict in Congress over the budget. The Republican and Democrats had agreed on a framework. They were working out the details.
Yeah.
Then the crisis in Ukraine happened. So the administration wants to spend more to support militarily the Ukrainian government, and also to do a bit of humanitarian relief. So there is a disagreement on that, but which means, current government funding expires next week on the 11th.
So I haven't heard anyone talking about this. So is that potential for some?
No, because it's a sideshow. I mean, no one wants to close down the government. So the most likely scenario is that we will get yet another continuing resolution rather than a full budget.
Yeah.
So a sideshow, really.
Yeah. Okay. One thing that I was just saying, which I would just share with people, I mean, people who are focused on commodities, obviously this is not that interesting, but if you can see that, which is something I have been looking at early last week, and it's still very relevant, which is, obviously, most kind of investors and macro investors know that we've had some massive moves in oil, and obviously everything going on probably means that this oil price shock will continue. But what's interesting is most of the movement has really come in the front months. So right now, this is, I guess, close on Friday. So this orange line is where currently prices are on the futures curve, and the green is where they were only 1 week ago. So 1 week ago, we're at $95 front month, and now we're at $115. But what's happened is the curve is very, very steep right now. So not crazy, this will happen, but it's a very steep backwardation. So if you look at, say, April futures where they closed compared to December futures, from 115 down to 94.5, on an annualized basis, if you just bought the December future, and eventually when it became the front month future, it went to the current level of April, that's a 30% return. So, which is, in my time of looking at oil, that's definitely one of the steepest backwardations I've seen. And considering everything that's happening in the world, I mean, obviously we all are praying for the Ukrainians and some kind of end to this. But this, and on top of that, obviously, which many people have talked about, the complete lack of investment, shutting down of nuclear, questions about coal. Probably, I don't think the price of oil is going to be coming down very quickly, in the next month or two. So this is a potential trade that investors could or should be looking at in context of everything going on. So I'll kind of leave it.
Definitely. I mean, we're not going to get a resolution anytime soon.
Yeah.
And even if the Europeans for now refuse to block Russian oil exports, there is enormous difficulty in getting those through because banks are very afraid of regulatory risk, insurers, same thing. And a lot of people are just very reluctant to touch anything Russian. So yeah,
100%. I mean, the last thing I'll just put is that the fact that Visa and MasterCard said that they're kind of shutting down business in Russia.
Yeah,
I think it was last night. Like that is, again, that's just a very big deal. And I know that from Russian friends, and my wife who's Russian and Ukrainian, they have their own kind of credit card, which I guess they're going to partner with Chinese payments company. And so they will focus on doing that. But again, that's just another example of like doesn't look like a short-term thing right now. This is a real separation from Russia and the US and Europe and a lot of the rest of the world. So this is very serious stuff. So
very serious. And, there is no pipeline to pipe Russian gas to China.
Yeah.
I mean, there is a pipeline, there is a small pipeline, and then there is another pipeline to pipe to Europe, but the two are not connected.
Yeah. I think a lot of people misunderstand that. They say, well, the Chinese can just do that. It doesn't work like that. They I think, agreed to build a pipeline, but there is not currently. And what it is, there's a pipeline to Asia, but it's very small.
Exactly.
And obviously gas, there's only so much you can put through the pipe at one time. So
yeah, you need a pipe, and it takes time to build one.
Right. Hopefully by some miracle, we'll have a much more happy discussion next weekend. But for this week, I just, good luck to everyone, and please reach out to Dominique, to myself, to Bilal, any of us. And that's it. And if anything else.
Thanks, Andrew, and good luck to everybody this week.
Awesome. Thanks. Bye.
Bye.